Raj Mehta of PPFAS Mutual Fund joins us right now on the show. Raj, good having you. Thanks much for joining in. You guys have this option of investing both locally and globally. Looking at the current context, where is it that you're finding the possibilities of a bigger bang for the buck? Is it in the local stocks or the global names?
So there are select opportunities available in both the markets. But more so in foreign markets, we are finding some technology companies which are available at reasonable prices and growing pretty well as well. So and in India as well, we have been finding select opportunities in very select pockets. So we don't have a market view as such, but select opportunities we are finding and deploying our funds.
Okay, so how much is the concentration right now in the equity fund, for example, in local versus global? And if you've not exhausted the limit, would you look to up the allocation on the global stocks currently?
Yeah, so current allocation is about 65% in Indian equities and 30% in foreign equities. So we have a sectoral limit for foreign stocks at about 35%. So we can go up to 35%, but we are more or less there, and there will be small tweaks here and there, but not a major change.
So what are you most bullish on in terms of making the bang for the buck, and in this current market situation, a stable portfolio is something what everybody wants?
Right. So we have been positive on private sector banks as well as autos. So over the last 1 year or so, we have seen a major correction in the autos, and there we see some major upside in the next 3 to 5 years. So from a period where we had waiting period for cars and bikes, we are now sitting at a situation where there is inventory at the dealer level, which has almost been cleared up now. But going ahead, we could see some good retail numbers as well. So we feel that it's a cyclical slowdown, not a structural slowdown. The cars and two-wheeler story is a long-term structural story in India, and it should bounce back 3 months, 6 months, 9 months. We don't know the timeline, but it should bounce back sometime next year.
Okay. We've been talking a whole lot about whether or not there are other themes that are likely to play up now. Whether you see manufacturing as a theme good enough to invest in, commodities is a play good enough to invest in, and financials obviously holds its own stature in your portfolio.
Right. So manufacturing, again, you need to look at stocks bottom up. So some sectors might fit in our criteria. So our criteria is first we look at the management, then we look at the business quality and the competitive advantages that they have, and then we look at the valuations. The last comes the valuations. So within the manufacturing space, there are very select opportunities and select stocks that we look at, and we are finding some opportunities there. On the commodities side, we feel that it's a very cyclical space, and we need to time our entry and exit very properly. So that's where we have stayed away from, because we have not been able to...
This is metals, cement and the other.
Right. So over the last 3 years, everybody has been saying that the infra spends and capital goods space will revive because of the private sector capex. But that has not happened over the last 3 years. So timing these spaces is very important, and we have not been able to gain conviction over there. So we have stayed away from this space.
Okay. What about the pharma space? I see that you guys have exposure to a couple of pharma companies as well. Do you think the pricing pressure issue, which has been there for the last 3 to 4 years, is out of the window now? One can look at fresh investment, because a lot of these pharma companies are available at cheap valuations.
You're right. So most of the pricing pressure is behind us, and we see that going ahead, we could see some growth in terms of the volume growth as well as pricing coming back to these pharma companies. And within the pharma space, it's really difficult to gain conviction as to which molecule or which drug would do well, because you need to really go into details as to what is the competition doing in terms of each molecule and drug, and that's why we have a basket approach here. So we have about 5 companies in our portfolio, and we have 1 to 2% allocation to each of these. So on top of this, you also have these US FDA troubles coming in every 6 months or so. So we feel that it is not a space where we can take a 5% position or a full position, and that's why we have a basket approach here.
Okay, you also mentioned 65% of the exposure is in Indian equities, right?
Right.
So majority of that is in private banks and autos, you mentioned. If I were to ask you, if you were to increase your exposure in any of these segments, which one at current valuation is giving you more comfort to buy more?
So both the sectors that you mentioned, we have been increasing exposure over the last 6 months or so. And one stock which we have added recently to our portfolio is CDSL. So it's basically a duopoly market where you have NSDL and CDSL, two players. It's a steady annuity revenue earning company where you don't need any fresh capital to grow your volume 10x or something, and they have various revenue streams. So you have the issuer charges that it earns from the companies, you have the transaction charges that it earns from the investors, and there are these e-voting fees that they earn, and there are many other revenue streams which they are earning. So going ahead also, we feel that they can dematerialize the insurance policies, the academic records, and many other revenue streams which could open for them. So we feel that it was reasonably valued, and that was the stock which we added in the last 6 months.
Similar should be the case also with, I think, asset management companies.
Yeah, so asset management companies, the problem is the valuations. So in the last 1 year or so, we have seen the valuations run up too much. So on the non-lending side, we like credit rating agencies, depositories, stock exchanges. These are the three spaces where we are positive on. But on the AMCs and the insurance side, we feel that the valuations have gone up too much in the last 1 year or so, and that's where we have stayed away from.
But that's also a very similar analysis to how we are viewing the polarization on the index as well, right? It's giving you returns and it's doing well for itself, and that's why it's commanding that premium.
Right.
And the stocks which are not doing well are not giving you that kind of a stock price return. So, I mean, while stock exchanges or while depositories may look good in valuations, they've really not done much in terms of the investor sentiment versus AMCs and insurance.
Right, so they haven't done that well in the past, but going ahead, who knows which sector will do well. So we'll have to wait and watch. And polarization in market is very much visible to everyone. The top 10 companies in the index have more than 60% weightage, and they have given almost 90% plus of the gains in the last 18 to 24 months. So we feel that beyond these 10 companies in the index, we feel that some companies might do well going ahead.
All right, we leave it at that. Thank you so very much for joining us. Really appreciate you taking out the time this afternoon and sharing your thoughts with us here, Raj.